So this week I had actually posted my video, my weekend review video on Friday. I usually post it Sunday. Oh my God, you guys are incredible. This was like, it wasn't quite double the view rate, but it was pretty high. I mean, we're well over 1,000 views, and maybe I'll start posting the weekend review videos on a little early, maybe like Friday afternoon or Saturdays. We'll see. That could be arranged. That just might have to start happening. As you know, I mostly like to do my Periscope videos as a supplemental. Yeah, if you click on the little gear on the YouTube, you can change the I guess the resolution. It even goes up to into the 1400s because I recorded on a 5K iMac, so it should be pretty crispy. Anyhow, the Periscope, the purpose of this is a supplemental video to the weekend review, which I really like to be more, I guess, technically oriented, and this one is a little bit more, I guess it would be the difference between quantitative and qualitative. So anyway, let's jump right in here. We had some Fed minutes today. I'm absolutely furious at the way the media covered this today. Really amateurish on their part. There was actually a guest, and I quote, I think the Fed is going to lower interest rates in 2016, so they better hurry and raise them now. What? I mean, that is like, I mean, I don't know how these people find themselves on TV. I mean, maybe the guy was drunk or something, but that sounded pretty ridiculous. Anyway, let me break down what the Fed really said today. I mean, I don't like to be too braggadocious, but I mean, no one has been understanding the Fed, at least not the guys on the TV. I think that I've been the only one who's really given the analysis that has turned out to be correct, and I've stuck by it through thick and thin. So I think if you want to give me a little bit of leeway and a little bit of street cred on that, you know, I might indulge. So what did the Fed really say today? So the last time, let's go through a little bit of I think you need to understand what the Fed said the last time to understand the subtle difference that happened this time. So last time the Fed said they kind of they hung their hat on not raising interest rates because of foreign concerns. And there was a firestorm in the media that the Fed was outside of their mandate and that they should be raising rates because growth is, you know, I guess whatever the people seem. I mean, growth is terrible. We all know this, and we're going to see what happens with the GDP tomorrow. But you know, they were basically saying the employment's good, and that, you know, the Fed should, you know, the economy's good, and the Fed should raise. And the Fed put a lot of emphasis on the mandate, or I guess their new mandate, quote unquote, that the world is slowing and that they're concerned about that. And they also, of course, mentioned that there's more they can do in the labor market and that they haven't reached their inflation target. So all the Fed did today was kind of ease their foot off and back away a little from the foreign concerns and re-emphasized on the domestic shit show. So you have the bad foreign, and now you have the bad domestic. So all the Fed did is, you ever see this game when you were a kid? You hold something in one hand, and then the adult puts it behind their back, and then it's, you know, usually in the other hand. That is what the Fed did. They just went from their dovish from their left hand to their dovish to their right hand. And they said that the employment data the statistics have weakened, and they have. They've also talked about they supposedly upgraded the consumer, although the consumer confidence numbers the other day were terrible. So I don't know what they're talking about. I guess these are lagging numbers. And they also said that business spending had been good. Jeff Lacker, again, you know, forget about this guy. He's always a dissenter. I mean, this guy wants to, I mean, he would be selling ice chips in the winter, for crying out loud, this guy. So, anyway, we all know that the inflation rate here is below target. We know the employment situation has been slowing. We know that since the last Fed meeting, the consumer confidence numbers are weakening. We all know China is slowing. They have a sub-7 GDP print. I think they had beat their GDP number by like 0.1. Just, I guess, you know, those. If you believe those numbers, you know, I got a bridge to sell you guys. So we're gonna really get to see a GDP number. I think really what the Fed also wanted to do was their last statement was so dovish. The numbers have been so crappy. The market has been up so much off the lows that they wanted to interject themselves and kind of take their neutered selves. They kind of wanted to put themselves back into the conversation. Now, as great as Chairman Bernanke was in communicating with the public, equally as bad as Janet Yellen is in communicating. She is just all over the place. They've got these Fed chatterboxes who come on television and just shoot their mouths off for whatever reason. And believe it or not, this was tried in the 1920s. There was an attempt by the Fed to do what's known as moral suasion, where they kind of try to talk the market down, or at least talk a good game and talk tough about having high, maybe that they'll raise interest rates. But I really just don't see that happening here. The economy to me is just not weak enough. There's still a ton of foreign risk, and we already have a super-duper strong dollar. Now, this is going to be a big problem. Today the dollar reversed and was up pretty big. I'm just looking on the ETF for that is the UUP. That really spiked and it held. I mean, this is a big problem. It broke the downtrend. If the rest of the world is loosening and the Fed is tightening, the dollar is going to go higher, and that's going to depress foreign earnings, and companies are going to start complaining big time. So I don't really understand what the Fed is trying to do. I think they're just trying to talk tough. That's really my opinion here. I think the media really got it wrong. When those minutes came out, they were saying it was hawkish. And then by the end of the day, there was like a total mea culpa. I mean, aren't these people, aren't they embarrassed? I mean, having to come back out again and say that they were wrong. So let me go through what happened in the market today and explain the price action. The market ran up into the Fed. I always say, and I said it yesterday, it's safer when you sell off into the Fed and you get the shake and bake. This was sort of the sell the news. You ran up, you had squeezed a lot of shorts, a lot of people just sold the news, and then, and I guess the why was the quote unquote hawkish minutes, and then when we got down to the lows, down to the point of control, which is like 70% of where yesterday's volume took place, the market reversed, and I guess everyone came out from under their desks and they realized it might be raining outside, but it wasn't a hawkish Fed. So we had a couple of other things that took place today with regard to stocks. You had Apple report earnings. I was a little bit surprised at their price action because the stock was very weak. I mean, it had an initial pop and then it sold off and was sort of flat in the after hours. And if a stock can't go higher on good earnings, you have to be careful. However, Apple today kind of rallied the whole day. It was a bit of a stealth rally, and I had said that 115 was really the important demarcation number, and if it's above 115, we see 119, 120, and if it's below 115, we could probably see 109, 107, and then 103, and then there's levels below. But we held the 115, and we closed at 119 and change. So we exactly perfect. It did what it had to do. I'd be a little bit careful first chasing here. If we do break through the 119 and 120 and hold, then I think the highs are back in play. Amazingly, it's very possible that there's an open gap that Apple could fill. There's actually there's two gaps. You might want to write these numbers down. If you're long, you might want to be a little bit careful as we come into them. The first important gap is 124.5. And then the real big one from when it just kind of fell out of bed was 130.75. So those are some areas you want to be careful at. The price action today was okay. We closed above the let's see. No, we didn't close above the 119. It looks like we did though. The close now, yeah, 119.27. Okay, so we did the 119.27, and we closed above the 119.23, which is good. So Apple to me looks okay. If you start losing the 100-day moving average, you might want to get a little bit more cautious there. Twitter reported. So the problem with Twitter was it had run a lot into earnings off the lows. I think there was a lot of sort of profit taking. Anyway, we all know that Jack Dorsey now is full-time and that Twitter is doing a lot to kind of better themselves and more streamline their service and better the company. I think the story there, though, was that nothing they've done has been included in the current quarter, and I think it's sort of the thinking that the worst is sort of behind them. And we held the 50-day moving average, and I said today if we could hold the 129 to 29.51, that area, those are some important past reference lows, that I would say that the worst is sort of behind the stock, and I think it could kind of rally. And the stock really kicked in and kind of, it did. I mean, it closed pretty well. It didn't close on the exact high of the day, but it filled the gap, and it closed where it needed to. I still say Facebook is better. That's another one I had mentioned in the weekend review. I even had guys, could you believe it? I still have guys trolling me on Facebook. I had a guy today who was talking about when interest rates rise, the stock is going to be cut in half and all this stuff. The same guy was telling me it wasn't going to 100, and today we closed, we hit 104. Anyway, I'm getting a little more cautious on Facebook just because it's run so many days. It's coming into their quarter. When something is run heavily into their quarter, these days it gaps again, right? But this is doing exactly what it did the last time. It's running on the Google numbers. I'd be a little bit cautious if you're not hedged. The puts are fairly cheap in there, believe it or not now. I would be hedged at the very least. I drew a regression line. I don't want to go over too much what I did in the weekend video, but up around the 205s to 206s starts becoming some resistance, some channel resistance, and even now it's a little bit closer to 207 but it's the 206s. That area could be a little bit of resistance. The 1.618 Fibonacci extensions, these are important numbers to write down. If you don't factor in the flash crash, it's 109.28, and if you do factor it in, it's 116.07. Holy cow, wouldn't that be something? But I would be looking to take a little bit of profits and plan to play by the dip. It's getting a little bit extended here. GoPro reported. I've been bearish on GoPro for so long. I've hated that stock since they came public. I said that I didn't think I thought the company was basically a joke. I didn't buy the social media aspect of it. I've been saying if you want that, buy Google because they have YouTube. I had been saying that I thought they were Flip Camera 2.0 and that I thought the stock was going to go to single digits eventually. I don't know that day is today. It's actually, believe it or not, a little bit oversold. But I had also discussed that as we got down to the reference lows into the the 28s, between there and the 26s, I forget where it was that I had bought. I bought, I think, in the 27s-ish, that the stock was due for a bounce. And the bounce was so limp and so weak. Today, we finally got some short covering, and I talked about trimming and trailing, and that kind of, I had said on the stream a couple of days ago, I want to be long into the print but not long for the print, and that turned out to be dead on balls accurate. The stock is trading much lower. It's in the 25s down here. I don't know if I would be first pressing shorts here because I think the IPO was like in the 24s. So it's probably going to be, I'm watching tomorrow to see if this is obviously going to be heavy volume, and I'm looking to see if it's going to reverse. I mean, the stock is just down so much. It really rubbed me the wrong way when they unlocked those shares. I don't care if it was for charity or whatever, you don't do that. That, to me, is playing foul. All right, let's go into the list. One more. I had mentioned... let me just take a look at this chart. Yeah, not too much going on there. Anyway, IWM. So IWM has been... Actually, let's start with SPY, because SPY is really the market, and that's really what we need to talk about. So I had mentioned a lot of levels on SPY that are important, and I had said that the first part of the resistance that we were going to come into was between 204.12 and 205.38. We stopped basically there on the downtrend line, and then you had a gap and hold over it. And then there were a couple of days of a little bit of pullback, and then today we were up. And I had said that if we can clear the 207s, that I thought we would see 210. We're pretty close here. Yeah, the high was almost 200. It was 208.98. So there might be a little bit more to go here. You know, I'll tell you, the market has rallied back so much from the breakdown that, as crazy as it sounds, and I had discussed this, that this could be a setup for some kind of a blow off top. You get the shake, and then bake, and maybe that'll put in a bigger, a longer term type of a situation. But we have passed a lot of levels here, and it's getting a little late in the bear thesis for, and late in the year. I think a lot of people have underperformed, and there could be some kind of a performance chase. That's not to say that there can't be a pullback. We've run a real lot. I'm less bullish here than maybe I was, 5 or 6 handles ago, or even 10 handles ago. I really had talk about trade location in real time. If you want to go back, I had said on basically the day we I think it was 9:29 or 9:28, I had said I thought we were going to, in that weekend video, I thought we were going to go back and retest the 187s. I said I didn't know about 182s, but 187s. We basically stopped there and never have looked back. So I hope some people caught that and benefited from it. I know it was very scary in real time there, but it often really is. So that's SPY. Now, IWM has been sort of what the bears have been hanging their hats on, and has been the fly in the ointment, so to speak, for a while. We are still below some pretty critical levels that I've discussed in the past. Those of you who have been following me for a while, you all know the significance of 117.37. I was thinking about getting a tattoo saying 117.37. No, I wasn't really thinking about getting a tattoo, but the number has a lot of significance. It's a really important line for the IWM to be over, and we've been below it for a while. The last time we sort of had a look above was on the 17th, and it failed. Now we're coming back up. But we've been in a bit of a consolidation, and it's almost, I don't want to say it's an inverse head and shoulders, but it sort of is an inverse head and shoulders. At the very least, maybe I don't know. I don't really use the pattern a lot, but the cup and handle, you got the cup and then the handle. Anyway, today you had a resolution over the consolidation, and today's candle isn't quite a Maribozo, but it sort of is enough to. It's sort of close enough for government work. Maribozo candle, by the way, if you're not a Steve Nissan student, and honestly, I believe it or not, I've never even really read the book. I've glossed over some of the stuff that's been online, but it's basically when you open on the dead low and close on the dead high without really wicks in the candle. It's really just a big-bodied candle. Those are really bullish. It engulfed multiple days. I mean, we've been in this consolidation pattern really for 1, 2, 3, 4, 5, 6, 11, 12, 13, 17 trading days, and today finally resolved higher with a big body candle. Now, the breakout could be false. We need now to see it hold over the 116s. If it can hold over 116s, then the IWM is going to probably try and make a run maybe back to the 120.58. And that will catch a lot of people off sides. I think a lot of people have been shorting IWM, and there could be a rotation now into small caps. Domestically, we'll see how that plays out. But that's really where you need to see IWM hold. If there's a break of the 116s, I think we're going to pull back mid-range at the very least, and that would be 114.63. Is that precise enough? So I think we would probably pull back into that mid-range around the 114s, probably 114.63. That's really like the widest point there. So that's where I'm seeing things. Someone asked about FireEye. I think they report soon, but you had the cybersecurity bill pass, and I had tweeted about that last night. I said maybe these things will finally start getting out of their own way. I've been waiting. I'm actually, in full disclosure, short some puts in here that are now performing pretty decently. The lows in there are a little bit poor. There's a smidgen of excess, but nothing really to write home about. But it is reversing up a little bit. Maybe there's a bit of a rally ahead of the print. If it rallies before earnings, you might want to take some off. If it continues chopping or is lower, then you might want to play it. Then you might want to play it a little bit longer into the print. It's really been weak. It's just been selling off in a straight line. I had said when this thing was, I had sold it. I don't think I caught the exact top, but it was pretty close. And I'll tell you, it's a hell of a lot higher than it is now. That it was starting to feel heavy. You would get good news, and the stock would rally, but it wasn't really rallying. It just felt like people were using it to sell. And there were some incremental higher highs, but it really was doing it sort of begrudgingly. You know, I always tell people, particularly newer traders, spend some time and learn how to read tape. Get to know the personality of a stock, how it behaves. You know, how will something react on good news? You know, oh yeah, it should be up a lot. If it's not, then that's a tell. Or if something should be down a lot and be getting crushed and it's not, that's also a tell. So that's really important. FireEye though, the IV is really high. If you're a FireEye bull, I would suggest selling puts as a long proxy. I think the IV is like 100%. Apple I covered. PayPal. You know, I've been kind of waiting to see. I was thinking long for this, but it ran ahead of the print. When something was down a lot and then runs ahead of the number, I get nervous. I think it's down actually in after hour. Let me take a look. I didn't even have a chance to check this out. 1 day, 5 minute. Yeah, it's down. Yeah, it's down a lot. You know, that's funny. This was really their first quarter. It was a pop and flop here. This was their first quarter. I have to look through it. It was a little odd to me that they didn't rally on eBay. eBay had a good quarter, but PayPal didn't really rally, and it should have. So that's an example of when something should do something and it doesn't. It's a little suspicious. That said, though, it did rise a bit into their earnings. I think that you could probably get long this stock if it winds up pulling back closer to like 31, 32. I think that area should catch it this time. I actually have a buy order in down there. It didn't trigger. I always love when my orders trigger and then I come back and I notice and the stock's much higher. It's so much better. It's just one of the. It's like sort of like going to the bathroom at a restaurant and you come back and the food's on the table. It's great. Anyhow, that's my take on PayPal. I don't really know that much about their earnings report. I need to look through it to really comment on the quality of it. But they obviously are down, and there'll probably be a little bit of a follow-through here on the disappointment. It probably doesn't have a lot of institutional support yet because it's new, so we'll have to see how that goes. So Baba ran. They had a pretty good quarter. It gapped into some resistance, basically, though. It gapped and it sold off. I had said to be a little bit careful and give it a couple of days. So today, basically, it's back up near those highs. So, you know, this stock ran a lot. It's coming into some resistance. I'm still a little bit cautious on it, but I'm willing to say that I would play by the dips in Baba. The story there is that I think they'll be strong into Singles Day, which is, I believe, 11/11. So I think you can play it long into Singles Day, and then you kind of want to be out on Singles Day, or maybe like right before Singles Day. Let's not forget, Singles Day was to the day it topped out, I believe. I think that was the all-time high. So let's be a little bit careful there. But you know, when you have a Fed day or you have an earnings day, that day's range is really the gauge. So with regard to Baba, if it broke 78.25, I'd want to play it short. And if it gets above 82.79, then I want to play long. That's it. And then you could use halfway into the bar as maybe your stop. Let's just keep it simple, stupid. That's my, hi, how are you? Thank you so much for making the Periscope. If you want to see this from the beginning, you can see it on my YouTube channel, which is Justin Pulitzer Trades. And of course, follow me on Twitter, which is just at Justin Pulitzer. So that's Baba. So someone asked about Microsoft. Let me talk. Yeah, let's just get this one out of the way. So this is sort of a my bad. You know, I really haven't believed in Microsoft, although I did say I thought that their products were getting better. You know, you can't focus on and follow every single stock and be in every single move at every single time. And Microsoft was just sort of one I thought was stodgy and it's just been in a consolidation range. And now you have this gap and go, and it's held for multiple days. So it's getting a little, we're getting close back to those 1999, 2000 highs. There's a few points higher. My guess is it's going to be attracted to there, and that the stock is probably going higher since it's holding this gap. If there were to be a pullback here, somewhere I would think between 50 and the gap fill was 48. Somewhere in that area, if there were to be a pullback there, like on a market swoon, you can probably play by the dip. I think that area will probably be some support now, or to sell some puts. But the stock is holding up pretty strong. It looks to me like they're going to try and take it there. Someone asked about oil. Yeah, let's talk about oil quickly, and then maybe we'll... Actually, let's do Gilead first. Someone asked about Gilead. All right, so Gilead, I was looking to play this long for earnings. I mentioned on the stream that I was very frustrated that it ran on that AbbVie hepatitis C news. That's one of their competitors who had got bad news, and Gilead ran, and it ruined the earnings play. Forcing trades can often be some of the most expensive losses. Price really matters, and Gilead just ran into the number. That was just the problem. It really pisses me off because it would have been obviously a great long, but it ran and that's it. It already had run. It was actually down on their print a little bit. There's been a lot of fear in this. We'll have to see what happens tonight in the Republican debate. I think Kramer had mentioned he's going to ask the candidates about that. So we all know Hillary Clinton has been bashing the drug prices, and that's been weighing on these companies. And I've said this before. I realize I have some new viewers, but realize that the news always falls along the line of least resistance, except usually at the top or at the bottom. Usually there's that last kind of rush, and that's usually where you have to be the most careful. Like if something's up huge, it gets amazing great news, and then it sells off, that's the top. And the same thing at the bottom. If it's down huge and there's really bad news and the stock goes up, that is usually the bottom. So that at the very extremes is sort of where it turns, but everything in between, if a stock's in a downtrend and it's just been listing, and then there's this big break, the big break was coming, and because it was anticipating the news, and the news was sort of along the line of least resistance. Same thing with a stock that's going up, excuse me, or consolidating. That when it gets the news, it's just because it's along the line of least resistance. Sorry, I'm choking here. Oil. So oil was a bit of a tell today in the Fed. Oil, when the Fed came out, oil didn't go down. It stayed strong, and it sort of has been multiple days down, and then today had a bit of an engulfing pattern. It was sort of it was a bit of a gap and go, and it took out 5 days of trading in one bar. That's pretty good. I like to see that. Oil got a little bit lower into the range. Actually, no, it got exactly where I thought, 42s. 43, 42. That was really sort of the lower end of where the range where it needed to hold. It closed kind of really a little bit below, but it's looking a little bit better. Longer term, I think personally, the low for oil is in. That doesn't mean that we're not going to retest the low or bang around in the range and it's going to be sloppy, but I've been operating on the premise that the lows are in oil. I think there's kind of two people in this world, Beatles people and Elvis people, and Beatles people can like Elvis and Elvis people can like the Beatles, but you can't like them both equally, and that's how I feel about oil. There are people in this world who believe in the bottom is in oil, and then there are people who don't believe the bottom is in oil. I'm one of the people that does think it's in, and I had played Exxon. I had talked about getting out at 83, and it worked. It got down big. It was down big to 80 yesterday. Today it's back up to 82. I think longer term Exxon's going higher. You can play by the dips. 76, like if they gap down on their earnings, 76 is really where I want to buy the dip. That was the breakout of the consolidation. Usually breakouts get retested and either they give and the stock falls down into the middle, at least the middle of that prior range. In this instance, that would be, let's just do it, right? That would be 72s, 73s if it fell down into the middle of the range. That's sort of where I see like this all, that was really sort of where the real bounce rally began. If it holds strong, I think it can see 86s. I think eventually this is going back up, maybe really way up. I don't want to even get into that, though. I like to handle it one level at a time, but I would be looking to play by the dips with this one. Chevron is another one. If that one dips down like close to 81.20-ish, that was the breakout of the wedge, I'd be looking to be a buyer down there. Ferrari, I covered that in my weekend review. I said I think this is, although today it was a hammer now with a slightly higher low, maybe it wants to bounce a bit. Anything below 55 is bearish. Anything back above 55, I guess, is a little bit more constructive. I am thinking this is more of a 2016 story, though. Early 2016, I think they have a lot of supply coming on. The stock is trading at like 30 times earnings, and it's got like 4% growth. That is major pay up. That doesn't usually end well. I'm going to end on one that I don't talk about a lot, but I had a bit of a back and forth with their CEO, actually, on Twitter, Danny Meyer, who cleared up something for me, and I was very appreciative of that. There was a Cranes article that talked about that he was looking to maybe sell his shares. It didn't strike me as something that would really be credible, but they sold the stock off nonetheless, and he clarified that for me. And anecdotally, this story is so powerful to me, at least psychologically. I had been eating in a Shake Shack with my mom, and the table was rough. It was broken. Part of the wood was broken. And she tweeted him about the table being broken, and he followed up with her, and it was fixed the next day. Holy cow. That's the kind of CEO that I want to be involved with. You know, there's a story in Reminiscences of a Stock Operator, which, by the way, is my Bible. If you want to know where I get a lot of my sort of my trading philosophies from, that's a lot of it comes from there. I've sort of updated it, and I've actually been thinking about rewriting it, sort of like with a modern day update. I've also been thinking about finally doing an options book. Everyone always asks me about options books. There's no options books. Maybe I'll write the options book. Anyway, that's another story. So I think that the story with the problem for Shack has been they ran up a lot. It's got a very small float, and it's also got an enormous short interest. So there's obviously going to be more shares that are coming on, and I think that they're counting on that being the case. But I do believe that the at least for a while that the lows might be in here. I was short some puts last week from the lows. They expired. I'm still short. I'm short in tiers. It's a bit of an illiquid stock. I'd be a little careful with it. But you know, the short thesis is that it trades at a huge amount per restaurant. They're going to open up more. You know, there's going to be growth in that. They're opening one up in my neighborhood in Williamsburg soon. I just read an article. So that's sort of my theory with regard to Shack. I think the lows could be in. I sort of have a side bet with a buddy of mine for a burger. If it gets to 39, I actually had been very bearish. I had been very bearish on Shack, just so you know. You know, when people were loving it in the 80s and, you know, close to 100, I was like, this stock is going to get cut in half or more. And I turned, as I often do, down at the dead lows. So let's see what happens. I think it could have a squeeze maybe into earnings. Shortsqueeze.com says it's an 80% short interest. FinViz says it's 33%. That mechanics of the stock market will squeeze that stock. I'm anticipating a pretty big move higher. It's a little illiquid in those options, and I had been pushing and pushing to get those options, and believe it or not, I didn't trade them for a while. I've only recently been getting into them. So finally I got into it, and my bias there is a little bit long. I do like their CEO. I think he's a really smart guy. I liked his response. I liked how he responded to me. I like how he handled fixing that table. And I don't believe he's going to be a seller with those shares. and I do believe the stock, it may have seen the sort of the worst of it. If it really ramps into the number, though, I'm going to flip my bias. Price matters, and I'll probably say wait and see a little bit. So that's my story, and I'm sticking to it with that. With regard to the Twitter CEO, I don't really know enough about Dorsey. I think he's a smart guy. Obviously, he created Twitter and Square, and he's a brilliant guy. Will he be the next Zuck is really the question. And that's always, everyone always says, who's the next Steve Jobs? There is no next Steve Jobs. Steve Jobs was great. Elon Musk is great. These are visionary CEOs. And whether Dorsey will be or not, I don't know. I do think that like I said, the worst might be behind the stock. If it can't hold 29, just GTFO. It'll probably go back to 25. If it can hold the 29s and rally, I would rather be long than short. That's my story, and I'm just going to stick to it. Anyhow, I think we covered a lot of good stuff here. If there's any questions, please message me. I have my DM open. Anyone can DM me on Twitter. My handle is @JustinPulitzer. Again, if you came in late to this, or if you want to rewatch it, or if you want to share it with people, it will be on my Twitter. It'll be on Twitter. I'll post the rebroadcast, but it's going to be on my YouTube channel, which is Justin Pulitzer Trades. So let's watch the debate. Let's see if any industries are mentioned there, and we'll have a good rest of the trading week. So cheers.